Richard Harris is joining us now, Chief Executive at Port Shelter Investment Management. Richard, good to have you with us here. Good morning. Thanks very much for your time. How are things looking, Richard, overall? The rally in the US, as I was pointing out earlier, seems to be broadening out. The Russell is rallying. Between Friday and today, the Russell is up about 5.5%. The Russell 2000 index. You have the banks rallying last night there. So it's not just the mega caps. Slowly seems to be broadening out, which is good news, right?
Yes, it's generally a good technical sign. I mean, it has been noticeable that the key tech stocks have been moving. You know, the stocks really related to AI. And I would guess I would put this down to, an AI move. Some people are looking at AI almost as if we looked at the .com, at the turn of the century. But no, it's nothing like that. But I think AI is a little bit of excitement. It has put some energy into shares that may be sensitive to that sort of thing, or may not be. It just depends how the market's taking the narrative. And that's certainly putting the markets up at the moment. But I see this really as being a temporary respite in an environment that still looks difficult.
Richard, the big Q globally is going to be the FOMC meet, 13th and 14th of June. It's expected to be a pause, but it's expected to be a hawkish pause because traders are anticipating that in the following meeting in July, the Fed is going to go ahead and raise interest rates following the jobs report. So this pause that we're going to get is just going to be for 1 month. It's going to be that hawkish skip. That's the new word that everyone's talking about. In that context, since we are still going to see some rate hikes, do you think the U.S. markets can continue to rally?
Well, the markets have been rallying despite interest rate rises. And I think what's happening at the moment is we are starting to see interest rate rises bite. I know in terms of what I'm seeing elsewhere that interest bills are going up for homeowners around the world, for companies around the world. Big companies are generally protected because they have quite a lot of cash and they're funding in different ways. But interest rates are beginning to bite. Nevertheless, we're still seeing the economies carry on quite well at the moment. We're seeing pretty well full employment in most Western markets. We're seeing huge vacancies too. We were seeing migrations around the world as people are moving to more richer economies, in search of employment, and that employment is certainly there. So this bull market, the long bull market we've had over the last 20 years, is dying very hard. And it's going to be very difficult, I think, for as inflation continues, as it does in this kind of environment, for the Fed really to be able to control it. And yes, I do think this is a hawkish pause. I do think they will have to move forward increasing interest rates. But I think in terms of other markets may have to increase more because inflation is higher in Europe, inflation is higher in the UK. The US has to control inflation as well, but I rather suspect that maybe their rate rises are going to be slower than perhaps rate rises we see elsewhere in the world.
All right. Hi, Richard. Morning. Nigel on this side. Richard, the last time you joined us, I think you were mentioning that you're neutral on China, but still the preference is towards China rather than India, maybe on the valuation front. Has that changed around how you're approaching emerging markets? And what's the call now between India and China?
Well, Nigel, you have a very long memory. It's always worrying for an analyst to speak to somebody who has a memory quite that long. Yes, I think that was right. I think the neutral call on China was right then. It's probably right now, although, I think one would favor India over than China at the moment. I think the thing that most analysts didn't realize was that the very long COVID restrictions that we had in China, you're talking the thick end of 3 years, has led to a real crisis of confidence. People don't want to spend. They don't really want to invest. The Chinese authorities are now taking baby steps towards trying to stimulate the economy, reducing fees. They're looking to try and get banks to lend more. They're trying to keep deposit rates relatively low so that people don't just stick their money in the bank. So they are taking baby steps towards investment. But I think the worry is we haven't seen the kind of post-COVID revenge spending in China that we saw in other markets. And I suspect that's because people are still very concerned, not very confident, and really just sitting on their hands. So yes, I favor India over China in that basis. I also favor India over China in terms of AI, not because necessarily AI isn't very successful and booming in China as well, but because India will benefit from a lot of the ancillary elements, a lot of the outsourcing elements that will probably come with AI.
Richard, we'll leave it there. Thank you very much for your time. Great speaking with you, as always. And thanks again for joining us here on CNBC TV 18. Well, Richard Harris of Port Shelter Investment Management with his perspective. We'll take a very quick break here. Our list of top stocks to watch out for is up next. Our research team will get you that when we are back in just a bit.